Hey everyone, today I have a couple of really exciting trades to talk about. One of them is a trade that I opened on the 9th of January. It was a square trade and I closed it today for a very nice profit. And the other one was my latest trade, my trade number 236 on Starbucks. It was a calendar spread. But before I talk about my latest trade, let's go back to Square and take a look at the daily chart, see what happened since the 9th of January. So this is the 9th over here, and as we can see, the price was trading at around $68 and now it's gone up to 88. So it was a really nice rally over the last couple of weeks. And fortunately, it worked out really well for me. What I did is I purchased a double calendar spread. So I sold a strangle expiring on the 17th of February and I purchased a strangle expiring a week later after the earnings. As we can see, the earnings is scheduled to be on the 23rd of February after the market close. I put together a little table in here to demonstrate what this trade looked like and how it worked out. So on the 9th of January, that's when I opened the trade. I sold the strangle expiring on the 17th of February. So I received some credit for it. Total credit is $2.70 to be exact. And I purchased the strangle expiring a week later, but with the same strike. So 55 is my put strike and 85 is my call strike. And this cost me $4.20. So the total cost of this double calendar was $1.50. When we're talking about options, you always have to multiply it by 100, and that's how you get the actual cash transaction. So this trade cost me $150, as we can see over here. So that's my total capital invested. And because it's a calendar spread, that is my maximum loss. I cannot lose more than $150. So that's the beauty of this particular trade. On the 2nd of February, I closed. So today I closed this trade. So I needed to purchase the strangle that I sold expiring on the 17th of February, and I had to spend $7.09. So as you can see, this cost me a fair bit of money because the price went above 85. So if you recall, the price is currently at 88.41. So my call strike is well in the money, and that's why this strangle itself didn't work out. It cost me a fair bit of money. However, because I also purchased the strangle expiring a week later, and on top of it, that particular expiration is after the earnings, this worked out really well. So when I sold this strangle, I received $9.26 credit for it. So the total profit of this trade is 67 cents, which represents an annualized return of 679%. So that's a beautiful low risk strategy with great return, and I wanted to show you why and how this worked out so beautifully. The first and most important thing is the IV, the volatility of this particular stock, and also the expirations. As we can see, the volatility for each expiration is different. And I took a screenshot on the 9th of January when I opened this trade. If you want to see the video that I created about this trade, then click on the link above. So if we look at the volatility at that time when I opened this trade, the 17th of February was at 69.8, while the 24th of February was 75.4. And if we look at what the volatility looks like now, the one that expires on the 17th of February gone from 69.8 to 66.3. So it came down, while the one expiring after the earnings went from 75.4 to 80.5. So that explains why the strangle that I sold expiring on the 17th of February lost value while the other one gained value. And that's irrespective of the price movement. That's just purely a volatility play. And the reason why this is such an interesting trade is because, first of all, the risk is really, really low. And also this type of trade is perfect in situations where the volatility in the market is very low. Like nowadays, the volatility is very low. However, the volatility for individual stocks always goes up before the earnings and drops after the earnings. So you can play this cycle every 3 months. Currently, I'm looking at another one, which is Nike. I already have that trade. If you want to see the video that I created about it, just click on the link above. So it's worth keeping this type of trade in mind, these calendar spreads in mind. Make sure that you study it. Make sure you understand how it works, and then you can really benefit from it, even if you have a tiny trading account. So let's go back to my trade number 236, which was Starbucks. So Starbucks had earnings after the close today. Fortunately, we already know the results by the time I'm doing this recording. So when the market closed, the price was at 109.15, and after the earnings, it's currently sitting around the 107, so a slight drop. And what I did is I sold the February 3 expiration, so that expires tomorrow. I sold the 110 put option, and I purchased the April 110 put option. So this trade cost me $2.31, and once again, that's my absolute maximum that I can lose. However, I know that I will not lose that money, because even if things work totally against me, I can always roll my position from February 3 expiration to another expiration and collect additional premium. I still have 78 days till the expiration on April 21st. On top of it, if we take a look at the volatility for the April expiration, it's at 30%, while the volatility that expires tomorrow is at 138%, almost 139. So once again, if you think about my previous trade, my square trade, this is pretty much the same sort of scenario. I can buy a strangle expiring further in the future, knowing that that expiration is going to be after the next earnings. So the volatility for that expiration will go up, and I can benefit from it. So this wraps up my trade number 236. I hope you find it useful. I hope you enjoyed it. If you have any questions, feel free to reach out to me via taekunitos.com, or just leave a comment and hit the like button, subscribe to my channel, and spread the word. Thank you for watching.